Josh, thanks everybody tuning in. Again, this is the time to stay connected during this kind of strange time that we find ourselves in, and hopefully on the back end of us. But really just want to go over some key financial principles, especially for young people, and then really have the time to answer questions regarding what is going on, whether that's in the markets, whether that's directly related to young people, and how to plan properly, set yourself up well for the future, so on and so forth. But with that, we'll go ahead and get started. And so number one, really what we want is about having a plan. And so interesting statistic, only 5% of Americans have any form of a written plan. And Benjamin Franklin's quote here is great: is if you fail to plan, you are planning to fail. And so it's interesting. There's another interesting statistic: 70% of Americans without a financial plan live paycheck to paycheck, regardless of their income. And so with that, we know that we need a plan, but if you're like me, you constantly are asking why. You want to read into which you're doing anything. And so why do we plan? And so first, let's look at scripture. Luke 12:28. I love this verse. It says, "For which of you desiring to build a tower to first sit down and count the cost, whether he has enough to complete it?" And in other words, the smart builder starts with a finished product in mind. They have a vision for what they want to build, and they count the cost to build it. You know, this verse goes on to say, it says, "Otherwise, when he has laid a foundation, not able to finish, all who see it begin to mock him, saying, this man began to build something and was not able to finish it." And so a great example of really kind of aimlessly walking into something without a plan is if you watch the show Shark Tank. There's a number of people who come in to present this idea to these sharks, and some come in obviously very well prepared with a great idea. They've got numbers and can answer questions very well, and then you've got others that somewhat aimlessly walk in and pitch an idea, and we've all seen those. And one that comes to mind is this gentleman that came in with the idea of the wake and bacon, and it's an alarm clock that is supposed to wake you up to the smell of bacon. It's a good idea in theory, but it was the design of it had many flaws. It was made of wood. It was a fire hazard, and when the sharks asked about all these different questions, he had no answer. And so obviously he did not get a deal, and the results of aimlessly walking into something without having a plan were very demonstrated in this situation. And so it's interesting. Everybody has a plan to some degree, and various aspects of our lives. If we're athletes, we go into games with a game plan. If we're teachers, we prepare curriculum before class. If even as our young people went to college just a few years ago, there was a process in place in order to choose a college. And so we have plans in all other areas of our lives, yet 75% of us don't have any form of a written plan. And so that's see if I can get this next slide. I'm having some issues with my internet connection. Can you hear me okay, Josh? Is it coming through clear?
It's a little breaking out, but keep rolling.
Okay. So that brings the question of really, what does a good plan look like? We know that we need a plan. So what does it look like? And first, let's break down some common misconceptions of what a financial plan may or may not look like. And as young people, I think a lot of us are more, we want to live in the moment. We want to have fun while we're young, and we think a plan might be restrictive or overbearing. When in reality, it's the most peace-providing and confidence-providing things. The American Psychology Association says that individuals with a financial plan experience significantly less stress in life. And so next, many young people might think that a plan may produce some anxiety if we're not reaching where we're at, or we get off track, or in reality, it's really just a measuring stick. Financial plan gives you a gauge of where you are in your journey, and allows you to measure against. So as we see these swings in the market, especially like we've seen lately, we're not phased by it because we're comparing what's on to our plan and making sure we're on track. And so operating without a plan is similar to trying to walk a straight line with a blindfold. But when you have a plan, it not only removes the blindfold, but it literally paints a straight line for you to stay on track. And then once you kind of sway or get off track, it allows you to see what you need to do in order to get back on track. And so then a good plan is, it has a budget, but it's not simply a budget. And so a good plan addresses the entire financial picture, and it illustrates how different financial decisions affect other areas of our lives. And so a good example of this right now is my wife has been wanting a puppy since we got married, and has been bugging me. And the problem is she's allergic to puppies. And so we're having to talk about hyperallergenic. And I think the price tag on a hyperallergenic puppy is pretty steep. And so that's one of the things we're having to weigh, is if we make this decision, the impacts it will have in other areas of our lives. And one of the things that we talk about a lot at Archetype, especially for families, is having a more holistic plan. And Josh, being somebody that has a family who's gone through the process of building a holistic plan and seen the positives of that, can you kind of elaborate on what we mean by a holistic plan?
Yeah, a holistic plan does a number of things. Number one, it gives you, you mentioned it earlier, it gives you a place to measure to. I was talking with a young guy just here in February, early February, who had a substantial amount of money in the market and some sitting in cash, but no plan. And he was trying to make a decision on, they just purchased a second home at the lake and had a mortgage on it. And he could have just paid off the mortgage and was trying to figure out what to do, but had never gone through the process of having a written plan and a comprehensive plan. And so before we could do anything, the guy he was working with the last week in February took $300,000 that was in cash and dumped it into the market, which we all know what happened starting the last week of February, the beginning of March. And then as the market just slid and tumbled down, not only was there not a good plan for that person, but his particular person wasn't necessarily operating under an investment discipline, but they sold out 500 points from the bottom. And so he locked in this massive loss. And he was panicking and calling me and talking to me still in that time. And what I kept telling him is, quit comparing to the market. Compare to your plan. If your plan says that you need X rate of return to get to your goals 15 years from now, and market history tells us that even with a downturn, you're still on track for that, then you really don't have to take on all this stress. So from a family standpoint, that reduces stress on the breadwinner, that reduces stress on the marriage, it reduces stress on the kids, but it also gives you a framework to begin to discuss finances with your kids. And so we sit down with our boys. I've got 3 boys that are 13, 17, and 20, and they get to see the plan. They get to touch the plan. They get to learn some of these things by processing through it. So it becomes very much goal-based. It begins to provide you a lack of the anxiety that happens a lot when the market's going all over the place. And it keeps you focused on what your goals really are. The other thing it does is it allows you flexibility. I mean, for most of us, our goals throughout life may shift and change somewhat. But having a plan allows you to see how changing one goal or one part of things trickles down and affects every other part in a very systematic way. And so you really want that comprehensive, holistic. And then as we get older, I'm not there yet, but I will be before long, that plan begins something that you start talking about wealth transfer. How do you transfer that wealth to the next generation? And so, our mission is to help families thrive across generations by matching their wealth with their purpose. So we typically work with 2 and sometimes even 3 generations of families to not only have a plan for the individual family unit, the immediate family unit, but also for the extended family unit that's going to be in the succession of wealth transfer. And again, having a good plan at every stage of that helps make that place seamless and improves communication. We know that Over 90% of all wealth is lost within 3 generations. And by far, the largest reason that wealth is lost, if you look at the studies, is because of a lack of communication. So a plan sort of gives you that framework for all of that stuff and brings a holistic healing to your family.
Yeah, absolutely, Josh. And what we're doing, it can be very difficult for young people to think about 30 years down the road in the future. But what you're doing right now is laying a foundation. And there's another story in Luke about that, of laying a solid foundation to build a house on. And that's what we're doing right now in our lives as young people, is building that foundation. Having a plan, it provides that peace and confidence to really help us weather the storms of all these swings in the market. As millennials, if you're towards the proportion of the millennial age, you've already experienced really 2 major downturns in the market. From 08, that was really right when some millennials were coming out of college into their first jobs, and now this one. And so if you were operating without a plan, it can be pretty scary, and a lot of uncertainty and stress that can be removed with some just careful planning and a good approach. And I like this George S. Patton quote: "A good plan today is better than a perfect plan tomorrow." And so that leads us into this next example I love to use when we're talking about planning, and it's the marshmallow test. And this is a test of delayed gratification, and we'll get more into more of the importance of that here in just a minute. But really, I don't know if you guys have seen this video on YouTube. If you haven't, I encourage you to go watch it. It's actually really funny. But the idea of waiting on a few things now in order for the payout here in a few years. And this example, a kid is given a marshmallow, and the lady that's conducting the experiment walks in and says, "Hey, you can have this one marshmallow. You can eat it now, but if you wait, I'll come back and give you another." And so I don't know how much time exactly goes by, but you can see the many facial expressions and the stress that he's enduring as he's waiting on this next marshmallow. But when he gets that second marshmallow, the joy on the child's face as he gets to now consume 2 marshmallows instead of just one, it's pretty funny, but it's a great example of what can happen if we understand the value of delayed gratification. And there's not really a better example of that than this idea of compound interest. And it's kind of the 6th wonder of the world, as Albert Einstein would say. And in this example, I wanted to give you just a real simple chart to demonstrate the value and power of compound interest. And so here we have 2 different individuals. We're going to have one that saves $6,000 a year, that simply keeps it in the bank and saves it in cash. The next is going to invest $6,000 a year, and we're going to run it at a very conservative 6% annual interest rate. And so 6% annualized over the next 35 years, you see at the bottom, it's going to come out to a little over $750,000. Whereas if you just saved in cash, maybe you didn't save at all or didn't save as much, but if let's say you did and you saved in cash, you're going to have less than $250,000. So you see the value of setting aside just a little bit of money each year, allow it to grow. And that brings us to this really next more practical example of not only learning compound interest, but the value of saving early and saving often. And so in this situation, we're going to look at a 25-year-old who starts saving $5,000 a year versus a 35-year-old who starts saving $5,000 a year. We're going to use the 7% annualized rate. And then we're going to look at, once those 2 people turn 60, what the difference in values are. And so at the very bottom right of the screen, you're going to see the 25-year-old who started saving $5,000 a year has almost $800,000, whereas the 35-year-old has just over $350,000. And so you see the difference in the value of saving early and saving often. And as young people, we really want to accomplish a lot while we're young. We want to go experience things. We want to travel. We want the new car. We want to be homeowners and into that new home. And I don't ever want to discourage anybody from accomplishing those goals. But what we do want to do is lay out the options and understand the opportunity cost at getting into the new home. And you see a lot of real estate agents right now saying, hey, 5% down and you can get into your forever home. And some of these just gimmicks, and those are great, but we need to look at what our options are. And Josh, as somebody who's purchased a home, as somebody who's been through the process of all this, can you add some color here on the value of really just laying out your options and understanding the opportunity cost?
Yeah, I think we live in such a highly marketed society that it's tempting for all of us at different times. I know I got a call from the son of a friend of mine who works for a Ford dealership. Now, I'm a Texas boy, so driving a truck is always high on my priority, and I drive a truck. And when all this was happening in March, he was calling me, telling me what kind of great deals they had going on trucks right now, and how I could, delay paying a car note for 3 months. And so he just laid out all this stuff, and the temptation is really strong. It seems too good to be true because it's too good to be true. You look at an offer like 5% down on buying a house. Well, in most places, if you only put 5% down on buying your house, you're going to get stuck for the next probably half of your mortgage having to pay PMI, which is an extra, $200-300 a month that you're not counting on when you're looking at things, which is just insurance, not on the home, but insurance on the mortgage that they're passing on to you because you don't have enough equity in the home. And so there's a lot of hidden details that have to be looked into. And it gets down, again, that comes back to financial planning. I used the example earlier of the person who had bought a lake home. Having those things are not terrible, but when is the right time to pay that off compared to investing in the market, compared to putting it in savings, compared to going on that vacation? Those are all different moving pieces that, again, coming back to having a good plan to start from will take into account and help you outline how you're going to do that. And that doesn't even bring in, the other big piece, which is, are you going to be a person who's giving to the social ills of the world? So for most people, giving, I really think most people want to be generous. I don't think there are a lot of people who don't care about the world around them. However, the old saying of, if you want me to believe your priorities, show me your calendar or show me your wallet. And so we have this idea that we want to be generous, but if we're not budgeting and having a plan, more than just a budget, but a plan that takes all that into consideration, then those things can begin to slip away as well.
Yeah, it's a good point, Josh. I love the saying of, if you really know a person's heart by looking at how they're spending their money. And so that's a great point, and thanks for adding color there, Josh. And that brings us to really our next financial principle of having a clear and disciplined approach to investing. And this might be the most important principle we talk about today, considering the circumstances we find ourselves in, with the market being down 34% at its low just a few weeks ago. A lot of uncertainty, a lot of panic. I think we just crossed 30 million people out of work. And so how does this affect the economy? How does this affect the market, the way we invest, timing, all of these things? And it's so important to have a clear and disciplined approach to investing. And what that does is, one, it provides a firm foundation that's built on evidence rather than opinion. You mentioned earlier the young guy that his investment advisor dumped a ton of cash in the market really right before we saw this downturn. And that's clear evidence that there's not really a disciplined approach, whereas it may have been smarter to dollar cost average in there over the next few months as we really were at the tail end of this 12-year bull run. And so obviously never want to dump in a ton of cash in at the top of the market. And so having a disciplined approach as we enter the market is big. This allows us to filter through the noise of a data-driven framework. And really, especially with today's news cycles, there's so much news coming at us. It's especially in times of crisis, all the good news is heightened as well as the bad news. And so it's either the end of the world or we're going to have a V-shaped recovery and we're going to be back to normal here in a month. And so really having a plan that blocks out a lot of that noise and allows us to really fine tune on a process when it comes to investing.
Yeah, Connor, markets tend to set pricing based on anticipation of the future. As much as it may feel like it's reacting to current news, even its reaction to current news is based on the anticipation of that news's impact on the future. And so, especially true in what we've just lived through with COVID, the market dropped when we didn't have any data. And then, all of us have seen how the data has shifted from the first week in March to the first week in April to now heading into the first week in May. And so, our principle with having a disciplined approach is wait until you have good, clean data to start making a lot of changes. Because as much as the market reacts in anticipation, and if it doesn't have good data, it will tend to overreact both positively and negatively. When you have good data, the market will move back to that good data. So, if there's not good data and we have a panic that has a sell-off, and you just hold steady as good data comes out, especially if it's better than the fear factor, then you're going to see the market move back to that level and back to that place. And you just can't respond emotionally.
Right. No, and that's exactly what kind of brings us to our next slide of what can happen when we're relying solely on emotions, or we don't have a process in place to help eliminate the emotions of investing. And this is a great chart. It's called the cycle of market emotions, or market emojis in this case. But it's a great chart because if you were to begin investing and stuck some money in the market just last year, this is a great example of what the performance would have been like. You would have started out, been optimistic. The market was up 25-30% last year. You were excited, euphoric at probably towards the end of the year and even into January. And then as late February hits, early March, mid-March, we start to fear, panic, anger, and the cycle of emotion begins because there's not really any clear process into our investing strategy. It's just kind of invest and hope for the best, and without really understanding what we're doing. And Yogi Berra's quote here is great. If you don't know where you are going, you just might end up somewhere else. And so even as we're young, we're beginning to invest, we should have an idea of where we want to go and ensure that our strategy is intact to get us there. And so it's interesting. Psychology Today came out with an article. This was probably 2 or 3 years ago now. And when we're overly excited, we tend to be overconfident and we take unnecessary risk. So we have this idea that nothing can go wrong. When we're anxious, we tend to shut down. Then we make no decision. And so if there is a time that we should either be investing more or maybe taking some equity off the table, we just shut down and don't make any decision at all. And then the other one was sadness. When we're sad, we end up settling and taking unnecessary losses. And so it's at that bottom, like your friend and there that sold 500 points from the bottom. That's just taking an unnecessary loss, when if he would have just stuck it out 3 weeks later, the market bounces 20%. That's what happens when we don't have a process or a plan in place. And this next chart really, it outlines the last couple of downturns that we've seen. The first one being the dot-com bubble in 2000, the next being the 2008, which is what most of us remember as the most recent one. And then obviously COVID, the one we're in right now. And it's Josh, I really want to hand it off to you here because you are someone that's lived through and a couple of these downturns. You understand the stress that people feel. You've seen advisors. I remember my dad telling me back in 2008, they had advisors in their office hiding underneath the table, not wanting to call their clients because they panicked and they didn't know what to do. And
literally, that's not a figure of speech. So in my brilliance, I got into wealth management on that chart there, late 99, early 2000.
Great
so
timing.
talk about not doing market timing. I didn't even time getting into this whole arena. And these downturns, professionals get freaked out sometimes. And there's a drawback that we talk to so many people who, 2.5 months into the current crisis, still have not talked to their wealth manager or their financial planner, or they've had one conversation. And it takes, for all of us, it takes a degree of accountability. The people I've seen weather these big downturns the best are people who have accountability and a team approach and are willing to listen. And we see that internally too. I just, being transparent, right? We have an investment council, and the investment council meets regularly. And even in this recent downturn, there are times that within the investment council, somebody shows up and is like, okay, maybe we're reading this wrong. Maybe this really is going to slide forever. And, but luckily when you have a team, then you have other people going, no, that's not how we make decisions. Let's get back to the data. And so I think that's really the big thing in these downturns, is sticking to the plan. I was thinking a while ago when you were talking, any of us that have been to business school, we were taught the principle when it comes to markets: buy low and sell high. And as one comedian says, that was interesting. He learned that from a book that he bought for $200 and sold back for $10, which sort of defeated the whole idea there. But I think that buy low and sell high concept, while absolutely true, can make us want to time the market. And no one times the market. You use data to make informed decisions. And then you have to look at the long run. And that's harder if you haven't lived through it. But, if you look back there, even 2008, which was such a terrible point. But if you look forward, 3 years, you've recovered everything and then some. And that's if you're 100%, in the S&P 500. There are things to do to weather these storms and to maintain a long-term outlook that ties to your plan. Again, not to what's happening in the immediacy of the market.
Right. And yeah, again, this does put a very narrow scope on things, is looking at one piece of data with this S&P 500. And at the bottom there, you see, like you just mentioned, if you were just stick it out, I mean, you're still not in bad shape. $1,000 invested 30 years ago is still over $8,000 today, and $1,000 invested every year 30 years ago is over $100,000. And so you can still weather the storms of the market with a clear, disciplined approach to investing. And then you touched on it really when you were talking, but with advisors and reaching out to, we've talked to many people over the last few weeks that still have not heard from their advisors, and this is an important principle to ensure you're receiving the level of service that you deserve from your team. And one of our principles at Archetype is that life is a team sport, and you've got to surround yourself with great people who do their job really well. And more than likely, if you're a successful person, you understand that you did not get to where you are today by yourself. You had help along the way. You had mentors. You had people that pushed you when you needed to be pushed, and so on and so forth. And the same goes as you start to build a family, as you start to look at where you want to be in the next 10 years. You've got to surround yourself with a good, solid team. And Pruitt Cathy puts it well, the founder of Chick-fil-A. He says, we're not in the chicken business, we're in the people business. And that same goes for us as people in the wealth management world. We are not in the money business. We are in the relationship business with people. Our job is to ensure that the people that we serve are doing well financially, but also doing well within their family units when it comes to talking about finances and communications around money and so on and so forth. It goes so much deeper than just the investments. And at Archetype, we talk about 4 different quadrants that make up who we are. And that one is the investments, obviously, but you've got building a strategic plan is a piece of that, talking about family dynamics, and then really establishing a legacy. And generosity also falls into that box, but it goes so far beyond money. And that's why I love this quote and this idea that you really do need to ensure the level of service you're getting is what you deserve. And example of that, and here, and Josh, you can talk about this a little bit too before I get into the Goldman example, but some of these kind of how the Wirehouse, you grew up in the Wirehouse at UBS, and you understand how that operates. So the difference really between an RIA, which is how we're established, versus a Wirehouse, and kind of hand it off to you to go into a little bit of that.
Yeah, I think the biggest difference, and let me just explain what a wirehouse is, because we use that internal language all the time. But a wirehouse is basically a large broker dealer. It's someone who is making the majority of their revenue off of transactions. And so Morgan Stanley, UBS, Merrill Lynch, these are all wirehouses. And they do some incredible things. There's no doubt there's some great things about these organizations. However, they are not true fiduciaries. And what's interesting is there's a lot of people who work at those firms that don't even realize they're not true fiduciaries. And so one of the big differences is a true fiduciary must, by law, operate in the best interest of the client. They cannot make any transaction, any recommendation that's not in the best interest of the client. At wirehouses, if you are so for example, Connor, you are you work with a registered investment advisor. You're an associate with that, and so that's where you're tied to. And as such, you must represent your clients to the best of their interests. You work for a wirehouse, you're actually an agent of the wirehouse, not of the client. And so as a result, you are required to operate in the best interest of the organization that you're an agent for, your company, instead of your client. Now, that doesn't mean that there's all negativity there, but the standard is different. So if you're at a wirehouse, the standard in making a recommendation is not the best interest of the client. The standard is this recommendation I'm making suitable for my client? Is there a measure of suitability? And that can change things greatly. And then when you do make a recommendation, instead of as we operate, where there's a percentage of assets that we're managing for a client, that you get all of our advice and all of our services for that percentage. If you do better as a result, guess what? We do better. If you do worse, we do worse. If you're at a wirehouse, it's transaction driven primarily. Which is I sell you a product or I buy a product, we make a transaction, and I get a commission off of that. And you have an example you're about to share that's pretty eye-opening regarding what just happened here in the markets.
Right, yeah, and you hit the nail on the head. And it's interesting, 80% of millennials who consider themselves financially successful do not utilize a financial advisor. And then 80% of affluent millennials are suspicious of this commission-based model. I mean, we grew up in a time where you had the Bernie Madoffs in the textbooks. You had Wolf of Wall Street on the big screen, and really just a lack of trust within the wealth management world. And this is even more evidence of why we have that lack of trust. And this is an example. This is an article that was put out literally 2 weeks ago. And or maybe, 2 weeks ago, Goldman Wealth Management net revenues up year over year despite fewer client assets. And so you're like, wait, how does that even make sense when the assets that you're managing is down, yet your revenues are up? And Goldman attributes it to higher assets under supervision, higher transaction volumes, and higher incentive fees. And so the advisors and the company itself are making money as your account values are going down. There's just something that's not right about that. And I think as millennials, we're hungry for real, authentic relationships. And when we see news like this, it discourages us from going out and finding help when it comes to our finances. And so again, we've got to ensure that we're receiving, one, the level of service that we deserve, and then two, we're being served in the right manner from a fiduciary standpoint. We need to be with somebody that truly has our best interest. And I'm not saying that the advisors here at some of these big wirehouses are bad people at all. 99% of them are great people. They're just serving on a platform that's flawed, and it's has nothing to do with their character or anything. It's just an unfortunate which is unfortunate where they find themselves from a platform standpoint. And so that brings us just to really some of the questions you should be asking as you are on this journey of financial success and finding a team to work with, and some of the things you should be asking in these meetings as you interview people to work with. And the first one, Josh has already talked about it, but are you a fiduciary? Do you have my best interest at all times? Do you wear different hats? Some of the examples we talk about at Archetype are at these wirehouses. If you're going in to get a mortgage or buy life insurance, or maybe a mutual fund that your advisor's selling you on, those are opportunities for conflicts of interest because they don't represent you in those situations. And so,
yet it can do suitability. It can be suitable for you to say have a growth mutual fund, but they maybe have been told that they're required that month to sell X amount of the proprietary mutual fund that either belongs to their company or that has been negotiated with another manager. And so out of that, when choosing between two growth funds, they're going to choose the one they've been told to sell, the proprietary one, or the one that there's back-end agreements on, rather than the one that might fit you better.
Absolutely. I mean, the next question, how do you get paid? Similar, really to that fiduciary question, are there commissions on the products that you're selling me? Is it a fee base? Are there other fees involved? Like the article we just saw that Goldman, there was incentive fees. Incentive fees for what? To get out of the market when it's down 20%, or what does that entail? And so we just need to be aware of what's going on, what we're being charged, and why. That goes along with what are my all-in costs. There are costs associated with investments. We use low-cost exchange-traded funds, or ETFs, to limit the cost of cost you to invest. And so typically our funds, or our portfolios, average, I believe, Josh, it's about 10 to 13 basis points, whereas mutual funds, fees on those can go up to over 1% on top of your management fee. And so you think you made 8 or 9% one year, and you really made 6 or 7% after all the fees. And then what is your investment philosophy? Do you have a plan, an exit strategy? Like we talked about, a disciplined approach. And we use what we describe as the 3 Dow philosophy. And I'm not going to dive into a ton of detail into how that all works, but if you're interested in learning more about our investment philosophy, Ethan Pollard, our senior portfolio manager, is going to lead a discussion, not next Wednesday, but the following Wednesday. I believe that's May 13th. And he will give a current market update, as well as dive into our 3 Dows, what we're seeing, the indicators that we use to gauge the market, and how we're investing new cash, so on and so forth. And so I'd encourage you to tune into that if you're interested into what our investment philosophy is. What is the asset allocation you would use for me? Is it appropriate? You understand my risk tolerance? Are you diversified across different sectors? What does that look like? Who is your custodian? Is it a well-known bank that my funds are going to be at, or is it somewhere that my funds could be tied up for a while? We use Charles Schwab, and it's one of the, if not the largest investment banks in the world at this point. And then benchmarks, those are things that you use to measure the performance of your portfolio. And then diving into who the company is itself. What is your mission? Who are you? What are you about? And like Josh mentioned earlier, at Archetype, our mission is to help families thrive across generations by connecting their money with their purpose. And lastly, the last 2 questions: what is your client service plan, and do you have a team approach? And Josh, I love how you talk about this approach and the example you use the car salesman. So I'm gonna let you take it from there. But
sure,
yeah.
The financial world is a unique industry in some ways. We're stuck in, and we got a question while you're going through this that I think I'll try and address at the same time, which is, why would anyone not want to utilize a true fiduciary based on this information? And so it sort of ties into all this. You have to understand some of the history about how these large investment banks came into being. It really was pretty much centralized around the railroad expansion in the United States, and they were raising money for that. And so they were very transactional in forming that, and then the market began to form and take off and things of that nature. And so you, by that point, had settled on a handful of companies who almost monopolized, definitely dominated the financial market for investing. And so you couldn't go directly to invest in laying the railroad. You had to go through someone. And so you had to go through one of these investment firms. And that sort of is the history and the background. And it ties into both the team approach as well as the answer on why people don't use a fiduciary. Part of the reason is honestly just because these other companies have billion-dollar, multi-million-dollar at least advertising budgets, and you see them around. You see their size. You know their prominence in the market. So a lot of people just don't even realize. Like I said earlier, there are people who work at these companies who don't realize that they're actually not a true fiduciary. I remember, talking with people when I was at a wirehouse who were convinced they were a fiduciary and didn't even realize, and they were licensed and employees of those institutions. Some people do it because there's a belief that the other services that these larger wirehouse non-fiduciary places offer have a benefit. There are definitely investment banking options that they offer that you might not find in a simple wealth manager. If you have a company and you're looking to do an IPO, you're doing those things. A lot of times they'll offer what we used to call more sophisticated versions of investing, derivatives, options. They'll have complex plans around those. Those have actually been falling out of favor more and more recently. The two fastest rising areas for high net worth people in America are using RIA only people, number one, and it's still a small segment, but it is the fastest growing segment. And number two is using ETFs in place of individual stocks or hedging or derivatives or things of that nature. And so sometimes it's just the people want to play with that. A lot of times it's people honestly don't want to pay for advice. They don't think they need it. Really started in the 90s with sort of the tech boom before that bubble posted of day trading. Day trading didn't exist before that. In fact, we used to say you don't rent a stock, you own a stock. You don't rent a share of ownership in a company, you hold on to it. And so as day trading took off, there are a lot of people who just don't believe that they need the advice. Truth of the matter is, statistically speaking, the average investor makes about 0.3% lower than inflation if they're not using someone to help them. And if they're using someone to help them, they make right around 6% versus 1.9% on their own. But they don't feel like they need the advice. If I don't pay for the advice, then why not just pay for the transaction? Not realizing that actually paying for the transaction may be more expensive than paying for the advice with the transaction as is needed. And then that ties into the question you were asking of a team approach, because the other thing that emerged then is guys who are financial advisors or financial planners, different companies use different phrases, really do everything. And so they're the person who first contacted you, who put on the event where you heard about them. They're the person who sits in the office during the day and watches the market. They're the person who picks stocks to buy, stocks to sell, mutual funds to buy, mutual funds to sell. They're the person who's doing their own marketing campaign. They're the person when things go south, they're supposed to do all the client service. It's all one person typically. And so what happens is you dilute your effectiveness. And so we believe in a team approach. We practice a team approach, but I would encourage anyone, even if you're not with us, make sure you're going with a team approach. We have people who are directly interacting with clients and doing things like we're doing right here, Connor. In our business development area, we have a team that handles all of our investments. They're investment counsel. And while we're expected to be knowledgeable, they're the ones who handle that. We have people who handle client service specifically. That's what they do. That's what they're experts in. And the example I use is, if you go to buy a new car, the car salesman walks you around the vehicle, you expect him to be able to tell you every question you have about the car, to be able to answer it with some degree of knowledge. And so you go out and you buy a truck and you take it out, and 3 weeks, 4 weeks later, you're out fishing, and you have it in 4-wheel drive to get down the riverbed. You're coming back out, and it won't shift out of 4-wheel drive back into 2-wheel drive. So you got to take it in to get it fixed. When you take it back to the dealership, none of us have the expectation that the guy who was the salesman for us is going to go throw on a pair of overalls and crawl under the car and open up our drivetrain. That we don't want that. We want the ASE certified technician who's in the back to be the one who does that, because he's the expert. And while he's doing that, we want to make a warranty claim. And again, we're not going to talk to our sales guy. We're going to go talk to the guy in the finance office who deals with warranties all day long. And so having that team approach really allows you to have the best level of service potentially that you could have, and the best level of performance, I would argue, as well. Well, we want to honor everyone's time. Connor and I will hang around for a little bit. If you have some questions, feel free to send those in. Lastly, I would tell you, if there's anything we can help you with, we'd love to talk to you and help you get to reach the goals that you have. We can help you with understanding of the markets, retirement accounts, family legacy, all of these different things you see there. But probably the most important thing I want to point out is there on the right. It just says, do you need? We want you to know it's been rough times, and people have dealt with a lot of stress and still are, with kids being at home and things going on. And so we don't mean to offend anyone. If it doesn't fit for you, that's fine. But if it does fit for you and there's anything that we can pray for you about in this time, we would love to support you in that endeavor and pray for you as well. With that, I'm going to wrap it up, turn it loose. If you want to hang around and ask questions, feel free. We'll hang out here. Thanks, guys. God bless.
Thanks, Josh.